Hello there, I hope that you are doing well. Welcome to this new lecture of the 2025 model series. During this lecture, I will share with you insights on determining your draw liquidity. Determining your draw liquidity is the most crucial aspect when it comes to your trading, and therefore this is a very important lecture and I highly suggest you to take notes. If you did not watch the prior lectures of this model series, I highly recommend you to watch those lectures first before watching this lecture. And the reason why is because I'm speaking to someone who has already gotten that foundational knowledge which I've provided prior. So with that being said, let us begin with this lecture. To begin this lecture, I would like to begin with the following quote. Trading without a draw liquidity is as if you're driving without a destination. Now I can already hear some of you think, but hey, I like to drive without a destination. I like to just spin around in the world and just drive around my city and just enjoy driving my car. Yes, I understand that. It's all fun and stuff, right? However, when it comes to trading, it's very important that you must note that you always need to have a destination when it comes to where the market is drawn towards. Your draw liquidity is so-called the end destination when you're driving within your car. Meaning you have a certain destination that you're driving towards, and when that destination gets reached, you're done with driving your car. You need to view trading the same way, meaning you must view the markets through the perspective of point A to point B, where point B is the destination. And the destination is until when you anticipate that the market is going to draw into that direction. And therefore, it's very important that you must understand that the draw liquidity is as a magnet on price, meaning the markets are drawn to these draws on liquidity. And therefore, your job is to be able to determine where they are. Methods to determine draws on liquidity. You can already read this correctly. There are multiple methods to determine the draw on liquidity. I will share all three methods with you today. However, what I would like you to understand is that you can pick the methods which suit you best. I highly suggest you to try and blend the methods and not rely on just one, because the precision is found in blending these three different methods with each other. First of all, we're paying attention to time cycles, meaning we're utilizing the logic that I taught prior within this model series to determine our draws on liquidity. Next step, we pay attention to key levels. And thirdly, we pay attention to PD arrays. When you try to blend all these three elements, it leads to high probability trading setups, as you will see during this lecture. Now, please note that if you did not watch the prior lectures of this 2025 model series, you're going to go into this lecture without any foundational knowledge about how to actually determine these three methods themselves. Do you now also understand why the first few lectures of this model series were on these topics themselves? When we pay attention to time cycles, the logic of time cycles is the following. What you must see is that I have three boxes right here in front of you. Inside of these three boxes, there are time cycles which are taking place, meaning box 1 is time cycle 1, box 2 is time cycle 2, and box 3 is time cycle 3. Now these boxes can represent whatever time cycle that you are looking at. In this case, I'm just going to refer to them as time cycles. This, by the way, shows you as well that you're able to apply this knowledge across all different time cycles. Meaning whether if you're a swing trader or whether if you're an intraday trader or whether if you're a long-term trader, it's all the same logic. It's all fractal. Both time as price are fractal. The only difference is the duration of the time cycles that you're looking at. Therefore, what I want you to understand is that time cycle 1 right here determines how time cycle 2 will deliver. Time cycle 2 will determine how time cycle 3 will deliver. Throughout each new time cycle, we refer back to the high and low of the previous time cycle. The reactions to these levels tell us the story for what's likely going to happen next. Meaning during time cycle 2, you refer to the high and low of time cycle 1. During time cycle 3, you refer to the high and low of time cycle 2. That's a very important process which you must be applying when it comes to making your analysis about the marketplace. Now, one thing which I would like to share with you before we dive into the next slide is the following. These time cycles are fixed, meaning they have a fixed starting point and a fixed end point. Where the highs and low form during that window of time is dynamic, meaning right now, let's say that it is currently the month of March at the time of this recording. Throughout the month of March, a high and low will form. This high and low will be referred to throughout the next month. However, in 1 year, what will happen is that the high and low of March will be at different price levels than this month. And therefore, what you see is that the start and end point is always fixed. It's the same. However, where the highs and lows form, that is what is adjustable. And that's a very important insight which you must understand. Because once we start looking at the key levels as well, you will begin to see that those are fixed and the time-based liquidity pools are dynamic. When we pay attention to utilizing time cycles for draws on liquidity, my main focus is on determining whether or not purge and reverts are taking place. What purge and reverts represent is the following. A purge and revert is basically the market taking out, in a bullish example, a previous cycle low, meaning this red line right here is the previous cycle low. We open low into that, take out the sell-side liquidity resting below this low. Then we see the signs present of a smart money reversal taking place. And then we see the market draw towards the upside. The moment that it displaces higher, we can immediately say, all right, the first draw on liquidity is going to be the previous cycle high, which is this buy-side liquidity pool. If we pay attention to the bearish example, it's the same logic but then in first, where you see that the market opens up a new time cycle, runs the previous cycle high, see the signs of a smart money reversal taking place, and then we see the market begin to expand towards the downside. Displacement lower takes place. When this displacement lower takes place, my eye is immediately drawn towards the previous cycle low, because below that low, sell-side liquidity has been engineered throughout that previous time cycle. Meaning, the logic behind time cycles suggests that between the start and the end of the previous cycle, liquidity will be engineered both above the high as below the low. And what IPDA will seek to do is that it will seek to take out the buy-side liquidity resting above the previous cycle high, above this green line, to then revert towards the sell-side liquidity resting below this low. This takes place inside of bearish markets, whilst the bullish example takes place inside of bullish markets. It's possible that you're still going to see these smaller fractals taking place inside of the opposing market environment, whereas, for example, you can see a bullish purge and revert of a smaller time cycle taking place inside of an overly bearish environment, and the same, of course, for the bearish purge and revert. This bearish purge and revert can also take place inside of a bullish environment, but then it's likely going to be short-lived, meaning it's likely going to be a purge and revert of a smaller time cycle. Why? Because the higher time cycles, the bigger ones, are suggesting that higher prices should be next. So it's very important to be able to say, okay, the bigger fractals are now in buy programs, or the bigger fractals are now in sell programs. If you're completely new and you're a completely new student of mine, I highly suggest you to just stick to trading in sync with the higher time frame order flow, because that is usually the easiest. Trading against the higher time frame order flow can be very tricky and requires way more experience, so keep that in mind. That is why I outlined to you the institutional order flow throughout the previous lecture. When we pay attention to a chart example then, what you can see right here is that the AM session is annotated right here, where you can see that the market formed the AM high right here and the AM low down here. Notice that when the afternoon session opened up, we saw the market drop lower, taking out the morning session's low, the AM low, and then we saw the signs become present of a reversal taking place. We then saw the market draw towards the upside. What is it likely going to draw towards? The market is likely going to draw towards the morning session's high, which is right here. Why? Because we purged the AM low, so now we can anticipate that the market is going to revert towards the AM high. And what's a very important thing to note here is the following. What I outlined is a purge and revert. However, the moment that this AM low is being taken out by this down close candle, you don't know yet whether or not it's a purge which is taking place, or if the liquidity is being swept. And that's a definition thing. Let me explain. Whenever the market takes out a time-based liquidity pool, so in this case the AM low, we call that the sweeping of liquidity which is taking place. The moment that we see the market form a low below that time-based liquidity pool, and we see it displace higher, from that moment in time, we call it a purge on liquidity. Why? Because then we see that smart money has bought below the morning session's low, below the previous time cycle low, and now we can anticipate that a buy program is going to unfold. And that's a very important definition which I want you to understand. It's the difference between sweeping liquidity and purging liquidity. Sweeping liquidity is simply the market taking out a liquidity pool. Purging the liquidity, however, is the market showing the willingness to form a new low below that previous cycle low to then distribute towards the upside. So purging is a sign of manipulation taking place. Whenever you recognize that manipulation is taking place and you see a purge on liquidity, you can anticipate that distribution is likely going to take place soon next. What will the market refer to? It will refer back to the previous time cycle's high, in this case the morning session's high. Notice that the morning session's high got taken out and the market retraces into an imbalance which got created throughout the repricing higher. Beautiful, isn't it? Purge of a previous cycle low referred towards the previous cycle high. When we pay attention to another example of this taking place then, but in this case a bearish example, what you can see is that between 7 to 8:30 AM, the first 90-minute cycle of the morning session is taking place. Notice that the market is expanding towards the upside during the beginning of this cycle. The market begins to grind towards the upside eventually, and notice how it begins to slow down. We can see consolidations taking place. Eventually at 8:30 AM, the second 90-minute cycle opens up, and we see the market run above the previous 90-minute cycle, its high, above the AM1 high. Notice that we eventually see the market come back below it, and we see the market begin a sell program, where we begin to see that premium rates are being created, and they begin to function as resistance price. From this moment in time, what you can anticipate is that the market is likely going to revert and draw towards the previous cycle low. Why? Because we took out buy-side liquidity engineered above this high. We see the signs of a reversal taking place up here, so now we can anticipate that IPDA will seek to draw towards sell-side liquidity. Where is sell-side liquidity? Sell-side liquidity is engineered below the previous 90-minute cycle lows. However, if we look inside of these fractals, what you can see is that these boxes represent 30-minute cycles. So even these relatively equal lows could be a potential draw on liquidity. Why? Because it is a previous 30-minute cycle low sell-side liquidity pool here. The same for this low. The same for these relatively equal lows here. So you must understand that within a bigger fractal, there are also smaller fractals which you can use as objectives. Now, as a general rule of thumb, this is where it's very important to note what the higher time frame order flow is and what you're anticipating from the bigger fractals. If you're anticipating lower prices from the bigger fractals, you can aim for full bulls, meaning you can aim for bigger objectives. If you are trading without an understanding, however, of the bigger fractal and it's not clear to you, that is when you partial or take profit aggressively. The next method of determining the draws on liquidity are by using key levels. When it comes to key levels, the levels which I'm referring to are the levels which are introduced throughout the 2024 model series. These levels are based upon quadrants, meaning we first of all have a box right here which represents the first quadrant from 0 to 25. We then have a second box. This second box represents the price range between 25 to 50. The third quadrant then represents the price range between 50 to 75, and the fourth quadrant represents the price range between 75 to 100. Now, as outlined prior throughout the price cycles lecture, what is very important to note is that you must be able to see what the sequence is currently that price is following. Meaning, just like there's a sequence in time, there's also a sequence in price. And that means what IPDA is doing is that it's referring to these reference points as reference points to simply say, okay, we're still in a buy program, we're still in a buy program, we're still in a buy program. Why? Because until that bigger draw on liquidity is reached, meaning that more important price level, that bigger price level, that is when you can anticipate every single expansion higher to be followed by a retracement lower to continue higher. Now, I understand that when looking at a schematic like this logic might not click just yet. However, when we pay attention to a chart, I'm 120% certain that it will click for you. When we pay attention to a chart example right here, what you can see is that we are looking at the Nasdaq chart. What you can see is that I've annotated the 21,000 price level right here, the 20,500 and the 20,000 price level. Throughout this week, what I outlined to you was the following. What I outlined to you was that as long as the market would not displace above the 21,000 price level, I would anticipate the market to draw lower. Why, oh why did I outline that? The reason why is due to the following. When you pay attention to this delivery on the left, what I would like you to see is that the market displaced through that 21,000 price level and a CB was created right here. As long as the market does not displace above this CB, I anticipate that what will happen is that IPTA is going to refer to the next dealing range. What is the next dealing range? From 21,000 to 2,000. Inside of that range, equilibrium, 50% of that range is right here, 20,500. Meaning, what I can anticipate is that around the 20,500 price level, we're likely going to see some form of consolidation. Notice how the market wicked multiple times below that orange line, which represents equilibrium of that bigger range. But notice how it took a long time before it finally displaced through it and reached that 20,000 price level. That shows to you that the reaction to equilibrium can be monitored whenever a new range gets entered. So notice that we displaced through a 21,000 price level with that CB. So from that moment in time, my eye is drawn to price levels below market price. Notice how we open up the week and month, repriced slightly above the 21,000 price level, but notice that the market then slammed towards the downside. That right there is a sign of bearish institutional order flow stepping in. Now understand that some of you might be looking at this example and you might be thinking to yourself, but hey, does that mean we're only using price ranges of 1,000 points? No, we can also use a price range of 100 points, for example. And that is a smaller price range. However, when you're looking at bigger price swings, you must of course use bigger ranges. When you're looking at smaller price swings, you must be paying attention to smaller ranges. So what I'm outlining to you now as well is how price is fractal, because IPTA is following the same logic on the higher time frames as that it does on the lower time frames. Just like I outlined that the time cycles are fractal, where we can apply the same logic over and over again, but across different time cycles, both smaller time cycles as bigger time cycles, the same applies to these price ranges, where we can apply the same logic on a smaller range as we do on a bigger range. And when you begin to understand this right here, it opens up a completely new perspective across all financial markets, because then it makes sense to you why and when the market is likely going to form, for example, swing highs and swing lows. And that is when you can see as well, when it comes to these bigger price ranges, where certain news events take place, where certain global events take place, where the media begins to push out a certain narrative. Once you're able to recognize what IPTA is doing next, you can anticipate what the news headlines are going to be. Now that's a completely different topic, which I'm going to save probably for a later lecture within this series. I could create a whole lecture on the importance of certain narratives and bigger narratives and how the news gets utilized for manipulation and distribution purposes. But this lecture is simply purely on the draws on liquidity. Now, the reason why this lecture is a very important lecture to study in depth is due to the following. What many of you do wrong is that you go into the charts and you begin to look for PD arrays. You begin to look for example, breakers and fair value gaps, and you think that every single break and fair value gap that appears is a trade setup. And you think that all you should do is just trade every single breaker that presents itself for every single fair value gap that presents itself. You might look at an SMT, you might implement a very simple element of time, such as a macro window, and you might think to yourself, now I'm trading as IPTA is trading. Well, you're beginning to see that I haven't even discussed any entry patterns with you yet. I haven't even discussed with you how to enter into a position. All that I'm outlining to you so far within this model series is how you can basically predict what's likely going to happen next. This doesn't mean that you're always going to be right. This doesn't mean that you're always going to win. However, it does mean that you're objectifying your approach to the market significantly. Why? Because these price ranges don't change, meaning they're fixed, they're predetermined. The same applies to the time cycles when it comes to when they take place, but the highs and lows of the time cycles are dynamic, meaning where the high and low of the time cycle will form is different. When it comes to these ranges, they're fixed, meaning this is the range high of 21,000, this is the range low of 20,000. Inside of that range, IPTA will seek to go back and forth until it displaces outside of this range. And that's a very important insight which you must have. The next chart example which we're going to take a look at is on the euro. Notice that the range which I have annotated right here is between 104 and 105. 104 is a range low, 105 is a range high. Notice that when you pay attention to this delivery on the left right here, what you can see is that we gapped open higher for the week through the 104 price level. Notice that the weekly open and monthly open is right here. We see the market reprice higher initially, and then we see it eventually open up for the new day, and we see these consecutive down close candles trade into the 104 price level. Notice that the market drops below that 104 price level with this wick, but notice that the bodies keep on closing at this price level right here. We then see the market expand towards the upside, and it displaces through the 104.5 price level. The moment that it displaces through this price level, what you can anticipate is that the next draw on liquidity is likely going to be the 105 price level. Notice that we see the market reprice towards this price level, and eventually we see the wicks go above it multiple times, but the bodies keep on closing below it right here. Now that this range high has been reached, we must monitor the reaction to this level. If the market is going to displace through this level, utilize as support and price, then we can anticipate that we're going to enter the next range. However, if the market is going to reject this level, then we're likely going to go back and forth inside of this range between 105 and 104. Now, what's important to note is what I just outlined to you when it comes to equilibrium. In the previous example, what you saw was that the market didn't displace through the equilibrium price level. Instead, we saw the market reprice through it multiple times, but not really utilize it as resistance on price within that bearish example. However, in this case, what you see is that we reprice through it, and the market is so bullish that it doesn't even have to retrace back into the price level. That right there shows that there is an urgency for the market to be repriced towards the upside. Therefore, you immediately should think to yourself, the draw on liquidity is likely going to be the current range high of 105. And this is how we can utilize these key levels to gauge the order flow. Meaning, we're moving from level 1 right here to equilibrium right here. And then we move on to the third level, which is right here. All you need is 3 lines like this. Need to know the range low, need to know equilibrium, need to know the range high. And inside of that range, you can even add the quadrants, meaning 25% and 75% to determine even more important levels to monitor. This is how you can utilize objective levels to gauge the order flow. Now, I understand that for the newer students of my mentorship, this is likely a bit confusing because this right here is a logic which isn't based on any price patterns at all. All that I'm looking for is the following. All that I'm looking for is how the market is reacting to these key levels, and based upon that, I can gauge the order flow. And that's a very important insight which I would like you to take away from this lecture, and that's why I'm putting emphasis on it. I do not need any candlestick to trade. All I need is the time and the price. Time comes first, then price. Hence the name of this mentorship, time, then price. Once you know that the time is right, you will see this delivery and price. This is a low resistance liquidity run. Now, what we can see right here in the following schematic is that I've blended both the time cycles as the key levels, and next to that, I've blended the PD arrays with this logic as well. Meaning I'm adding all 3 elements to each other. During this lecture, I will not explain the PD arrays at all, and the reason why is because the PD arrays have already been explained throughout the previous lecture. However, what I would like you to see is that I'm blending the 3 different elements of determining your draw on liquidity into one. Meaning, what you can see is that both the time cycles as the key levels as the PD arrays are being added into one so that I can anticipate a buy program stepping in. Now, the schematic in front of you might look very confusing to a newer student. Understand that if you haven't studied long enough, this might be like, what does this drawing represent or whatever, right? However, I'm going to walk you through it step by step, and I promise that if you listen closely, you will know exactly what the logic is which I'm representing to you. First of all, it's important to note that we're looking at a buy program, meaning we're looking at a bullish example. What we can see is that the market reached a range high right here, and we saw the market consolidate. We saw the market drop towards the downside, and we saw it displace lower. We see a blue shaded box get plotted right here, which represents a bearish fair value gap, a CB. Market retraces, and we see another CB get created. Notice that at this moment in time, a new time cycle is opening. This time cycle opens because this vertical line is plotted right here. The market retraces, and we see it retrace back into that blue shaded box, into that CB. An expansion leg lower occurs, and the market retraces and expands lower one more time. Notice that we see the market expand towards the range low, utilizing the key levels, and we see the market retrace. Eventually, we see the market have one more drop towards the downside right here, taking out sell-side liquidity, resting below this low, trading below the key level, and we then see the smart money reversal taking place. From this moment in time, what we can say is that the sell side of the curve is completed, and now we can anticipate the buy side of the curve to take place. This is what your focus has to be on, becoming very good at recognizing reversals. When you become very good at recognizing smart money reversals, trading the right side of the curve will be very straightforward. Why? Because the right side of the curve is a reflection of the left side of the curve. So when you know that the program is changing from sell to buy program, all that there's left to do is paying attention to the left side of the curve and utilizing that to gauge the order flow on the right side of the curve. Notice that the market expands towards the upside, and we see it displays above this high. A retracement takes place, but notice that throughout this retracement, a new time cycle is opening up. Now, from this moment in time, what your eye must be drawn towards is, alright, where is the previous cycle low, where is the previous cycle high? The previous cycle low is down here, and the previous cycle high is up here. Do we anticipate the market to take out the previous cycle low before heading higher? No. Why not? Because the smart money reversal is already in throughout this second time cycle. Why do I mention second time cycle? One time cycle, second time cycle, third time cycle. 3 boxes. 1, 2, 3. What we can see is that the market retraces into this high, finds support there, open low of the new time cycle, and then we see the market expand towards the upside. Notice that it now trades above this green line, which represents that previous cycle high. Notice that the market takes out that high and then a retracement takes place. From this moment in time, our eye is drawn to whether or not this high is going to function as support on price. If that high functions as support on price, we can anticipate that further continuation higher is likely going to follow soon. Meaning the moment that the market expands higher like this, and it displaces above this CB, this blue shaded box, we must say to ourselves, okay, we're now in a continuation profile for this third cycle. And again, these cycles are fractal, meaning you can choose whatever cycle you're looking at based upon the time frame that you're making your analysis. The market finds support inside that previous cycle high, and we see it expand higher. Now that we have displaced above this CB, we must see that CB function as support on price. Why? Because it has to function as an inversion to value gap. The market utilizes that inversion to value gap as support on price and expands higher once more, displacing through this CB right here. The moment that it displaces through that CB, we must see that CB function as support on price because it must function as support on the right side of the curve. The left side of the curve determines how the right side of the curve is going to deliver. Eventually the market expands higher, takes out the original consolidation of the first time cycle and reaches the range high. This right here is a buy program from range low to range high completed. Pay attention to the fact that I outlined that we have those multiple time cycles here, and next that I've annotated the quadrants. Because if you pay close attention, what you can see is that we have a first quadrant, second, third, and fourth. When you pay attention to an example then on the charts, what you can see right here is the following. What you can see is that I have annotated first of all the 19,250 price level by this red line, and next that you can see that I've annotated the 19,500 price level. Meaning I'm operating within this quadrant range, within the 19,000 to 20,000 price range. What you can see is that the launch cycle delivered, we saw the market initially run higher and then drop towards the downside. Notice how the market spent some time around equilibrium, around 90,500. We saw the market then reprice lower. Consolidation is taking place, and notice that we saw the market reprice lower one more time. What is it drawn towards? It's drawn towards the launch low and the AM low in this case, but we're paying attention purely to the launch low in this example. And we see the market reach the 19,250 price level. Notice that throughout this expansion towards the downside, the sell side of the curve, we saw multiple imbalances get created. The first imbalance which I'm paying attention to is this imbalance right here. Next that I'm paying attention to this imbalance. And thirdly, I'm paying attention to this imbalance right here. Of course, smaller imbalances also form throughout this repricing lower, but for this explanation, I want you to purely focus on these imbalances right here. They are the most important ones. Notice that we see the market reprice below the 19,250 price level, and we see the market spend some time there. Notice that eventually a low forms, and we see the market displays back above that level. Now, what's very important to note is that when it comes to these key levels, you're not going to see the absolute highs and lows always form at these levels. Meaning sometimes what will happen is that the market will drop just below the level and then form the smart money reversal. Or it will run just above the level and then form the smart money reversal. These levels are meant to gauge the order flow. Meaning they are meant to provide you with structure when it comes to price. Your job is to recognize when the reversals are taking place. But please keep in mind that the reversals can take place around the levels, meaning not exactly at them. And it's a very important insight to have, because I know that some of you are probably looking at this lecture, you think to yourselves, okay, every single time we reach this key level, I'm going to buy or I'm going to look to sell. No, that's not what I'm outlining. What I'm outlining is that the moment that you recognize that the reversal is in close proximity to this range low, to this level, you can anticipate that the market is likely going to draw towards the opposing side of the range, which is 19,500 right here. Notice that the market displaces through this CB, functions as support and price. Displaces through this CB as well after initially rejecting it, and we see the market reprice higher, taking out buy-side liquidity resting above this high. Why oh why is this buy-side liquidity pool important? I would like you to pause the lecture for a moment and I want you to think about that. I know that some of you never pause these lectures and you're probably watching this series as if it's your favorite Netflix series, and and yet you're surprised that you don't understand the full logic which I'm outlining to you. You must investigate in great detail what I'm outlining to you. This doesn't come overnight. It's not like you are able to just watch the lecture and boom, there it clicks. No, it's going to take a lot of work and a lot of effort for you to be able to recognize these algorithmic signatures. However, once you're able to see this, you will never be able to unsee this. And that's what I want you to keep in mind no matter what. Will it be hard to understand this logic? Will it be challenging to get to this level of understanding? Absolutely. You're going to be faced with hardships. You're going to be faced with moments in your journey where you're going to feel like throwing in the towel. But it's your job to keep on moving forward no matter what. It's your job to keep on investigating. I understand that some of you might even have your head spinning right now whilst watching this lecture because I'm sharing so much information. I understand that you might even have a headache or something like that, but that is all part of the journey. And the reason why is because your mind is now processing all the information which you're being introduced to. And it's not going to click in one go. I'm 130% confident in that. It's not going to click right away. However, when you think about the logic which I'm introducing to you during today's lecture, whilst you're not even watching this lecture, so it means whilst you're, going about your day, maybe you're bringing your kids to school or you're going for a walk or you're at work and you keep on thinking about the charts and you keep on thinking about why price is stopping where it's stopping or why it's drawn to where it's drawn. When you start thinking about that right there, I promise to you, right here on the spot, you are going to experience light bulb moments. And when you experience those light bulb moments in which everything begins to click, that's when you need to grab a piece of paper, grab a pen, and start writing down what you just thought of. You could also cause these light bulb moments to take place by actually putting yourself in that environment, by forcing yourself to think. And the way you do that is by also grabbing a piece of paper with a pen and start writing down, okay, these type of schematics, which I'm showcasing during this lecture. Once you start looking for these algorithmic signatures, when it comes to these time cycles, when it comes to these key levels, when it comes to these PD arrays, and you start blending the three elements, it opens up a completely new dimension when it comes to viewing the financial markets. And it will be hard for you to speak to someone who doesn't understand this. And the reason why is due to the fact that this is hidden in plain sight, meaning these time cycles and these price cycles have been going on for decades, if not centuries, guys. You could be literally looking at charts from the 1800s or prior, and you'll be able to see the same time cycles and the same key levels being respected. Why? Because back in the day, this was the logic which was being used to manually reprice the markets. When the transition to digital markets took place, to electronic markets, algorithms took over, and these algorithms were coded to follow this logic. And that's what you're beginning to see, where there are objective rules in place, where these price cycles are fixed, they don't change, the prices are fixed. However, where the highs and the lows of these time cycles form is dynamic, and your job is to look for engineered liquidity. Yep. When it comes to why this buy-side liquidity pool in particular is so important, it's due to the following. What you can see is that this high right here formed inside of this CB on the left side of the curve. But do you see how the market just stepped that high right here during a 30-minute cycle? We see the market reprice lower and eventually it runs higher one more time. Do you see how much back and forth going there is in this area? This is the engineering of buy-side liquidity which is taking place, because what you can see is that another 30-minute cycle high is forming right below the previous 30-minute cycle low. Therefore, retail money traders look at these highs as strong resistance, so to say. And therefore, what you can anticipate is that the market is going to draw towards this engineered buy-side liquidity when the time is right. When you pay attention to where these highs formed, you can see that they formed right in advance of this CB. This high actually formed inside of the CB. It just tapped it, IO fat, and then we saw expansion lower taking place. But relative to the range, what you can see is that they formed in advance of the 19,500 price level. And therefore, this is perfect engineered buy-side liquidity. So let's pay attention to the bearish example then. Here we're at the bearish example, and what you can see is the following. What you can see is that this is simply the schematic of the buy program, but then inversed, where I can see that the market reached the range low and it slowly began expanding towards the upside. This expansion lower which is taking place is rather slow, and the reason why it has to be slow is because it's inside of this slow repricing higher that liquidity is being engineered below these lows in the form of trendline liquidity. The market expands towards the upside, retraces, expands higher, a new time cycle opens up right here. A retracement takes place, and we see the market expand towards the upside one more time. Notice that the market forms a new high and we see a retracement taking place. Another expansion leg higher takes place and the market reaches the range high. A retracement occurs and the market then has one more push higher, taking out buy-side liquidity resting above this high. Notice that we see a rejection taking place and then we see the market displace towards the downside. Notice that we see displacement in the form of the creation of this CB, this bearish value gap. So I just outlined to you that on the left side of the curve there are imbalances within the buy programs. You can see that within the sell programs, I've now shown to you that there are imbalances on the right side of the curve which will form as well. Keep in mind that on the left side of the curve there will also be imbalances. Now what you can see is that this imbalance right here shows to you that there's an urgency for the market to reprice lower. This imbalance gets created at this key price level. We displace through this price level right here. We displace below this low which set up this final run higher. And from this moment in time, you can anticipate that we're in fact in that sell program. Now, it's very important to note when it comes to the examples that I'm showing to you within these schematics, is that these schematics right here represent a specific logic. And your job is to look for the logic. Your job is not to paste this chart example on any chart that you might be looking at and specifically looking for this. Because sometimes the SMR is going to form exactly at your range high and it's going to just form the high here and then begin doing the displacement legs lower and basically beginning the sell programs. Other times you're going to see some correlating outside of the lines, and this is what you must allow for, where you would see that the market reprices above the range high and then eventually begins to roll over. See the market slam towards the downside and then a retracement higher takes place. Notice that a new time cycle opens up right here and we see the market displace lower once more. We see the market create a new CB and notice that we take out the previous cycle low, this red shaded line right here. A retracement takes place into that low, into this imbalance, and from this moment in time what we're monitoring is whether or not we're going to see this imbalance and specifically this low function as resistance from price. The reason why is because we anticipate that the market is in a sell program now. Therefore, we anticipate every single displacement leg lower through a previous cycle low through key levels with the creation of PD arrays in the form of imbalances is going to lead to further continuation lower. I hope that you paid attention to what I just outlined. See the market reprice lower and eventually it reaches the draw and liquidity of this red line right here. We take out the original consolidation, which was right here, and this is your market maker sell model done. Now, what's very important to note again is the fact that within this schematic, I've put the imbalance on the right side of the curve to show to you that there are imbalances which will form on the right side of the curve. But please keep in mind that when we pay attention to the left side of the curve, there will also be imbalances. Here you can see an example of these ranges being applied to ES. What you can see is that throughout the second 90-minute cycle of the afternoon session, the market was being repriced towards the upside. Notice that it was in a rush to reprice higher, and you see that because the market is working through all these key levels to monitor. Notice that we see the market eventually create this sequence of imbalances right here. Notice them annotating both of them. And we see the market form the high of the second 90-minute cycle right here. A retracement takes place into that sequence of imbalances, and we then see the market find support there before expanding towards the upside. Notice that a 30-minute cycle low is being engineered right here, or is being formed, I should say. We see the market run up higher, and notice how it's going back and forth, and slowly grinding towards the upside. Eventually the market reaches the 5,875 price level, and notice how it just steps above that level and immediately rejects it. It begins to slam towards the downside. Notice that the market is now repricing through all these key levels, where you can see that the market reprices through the 5,850 price level, random place where the PM2 high formed right, and we see the market begin this sell program. Notice that the market is now in a rush to draw towards sell side. Why? Because throughout this buy side of the curve, the market was drawn towards buy side liquidity. It was drawn towards old highs. It was being repriced higher. Throughout this run higher, which was rather slow, a lot of sell side liquidity has been engineered. So when the time is right, what IPTA will seek to do is that it will seek to go from buy program to sell program. And what you can see is that the market displaces through that 5,850 price level. Multiple imbalances get created, but the market is so bearish that it doesn't even retrace. It just simply reprices lower. It's drawn towards this sell-side liquidity pool of this 30-minute cycle low. Notice that we take that out, reach the 5,825 price level, retracement higher takes place, and we then see the market eventually displace through the imbalance, which I've annotated right here. And next that you see the market displays through this 5,825 price level. The market forms a new low and it retraces higher. Do you see how the wicks step above that 5,825 price level, reach the price range of that sequence of imbalances, this blue shaded box, and reject it to slam even lower? What is the market drawn towards? The market is drawn towards those key levels below market price and towards the sell side liquidity resting below the previous cycle low. Why? Because we took out the previous cycle high, and now the market is drawn towards the previous cycle low, which is right here. Eventually, the 5,775 level gets reached, and the market forms the low there before retracing. Beautiful sell program once again. So what you can see is that a buy program turns into a sell program, just like a sell program turns into a buy program. What I suggest you to do to investigate what I outlined during this lecture is applying these time cycles on your charts. You can utilize this time cycles indicator for that. Applying these price ranges on your chart. You can utilize the advanced price ranges indicator for that. Both are available on the mentorship platform, meaning as a student of mine, you can get access to these indicators. You can add them to your trading view and they will make the whole backtesting aspect way easier for you. And what I suggest you to do is then to start blending the two elements so that you're able to see, okay, where are the levels based upon the indicators it's plotting. It's doing that calculation for you, so it saves you a lot of time. And next to that, where are the time cycles, meaning where are these start and end of these time windows. And once you start paying attention to both time cycles as these ranges, I promise to you that you're going to see a completely different side of the markets that you have never seen before. Once you start adding the PD arrays to that as well, you will see that determining drawing liquidity is a very straightforward process. I'm not saying it's easy, I'm not saying that you're going to get it right away, but I do promise that this is the only true way to come to objectivity when it comes to your analysis and perception behind the charts. With that being said, this lecture comes to an end. I hope that you found it insightful. As a homework assignment, I want to simply task you to get as many chart time in as possible. Try and get in as many chart examples as possible of this logic being applied, because this is what your focus should be on now. We're going to dive into the details way down the line, but for now, focus on this right here. Thank you for watching this lecture all the way to the end. I look forward to speaking to you soon again in the next episode. Be safe.